I am Vinney Chopra. Namaste. I'm a commercial real estate investor, syndicator, and fund manager. We have over $1 billion in AUM, and I'm also the host of 2 live shows and weekly podcasts. I have written 3 books also on multifamily syndication investing, positivity, and senior living.
And I am Farrukh Shakil. Assalamu alaikum. I'm a small business owner and a real estate investor as well, and have started, grown, and exited multiple businesses over the past 10 years. Welcome to the Desi Money Show,
where we are about to celebrate the accomplishments of Desi personalities who came to USA with almost nothing, but have achieved great success.
Our mission is to share insightful experiences and welcome others to contribute their inspiring stories to help you on your path to success. Get ready to chat with incredible Desi entrepreneurs who have gone from zero to hero.
So grab your samosas and gulab jamun, settle in, and let's dive into the world of Desi hustle like never before. Hi there, everybody. This is Vinney Chopra and Farrukh Shakil. We are back with
guys.
another show of the Desi Money Show, where we feature great personalities who have really gone from zero to hero, and they are specialists in their field. We got a great guest today. You're going to love him. Amit Chandan, just like, Chandan, as you know, in Indian language, that's the fragrance. And that's what we have, the stock guru, the stock market guru fragrance with all over the world, spreading it right here from Canada. I'm so glad to have Amitji here. He's a great friend of mine, and he runs actually a management consulting practice in Canada for 17 years. He's been doing it, managing over. Amit Chandan is avid stock market investor and a partner in the hedge fund also, with a background in computer engineering as well as MBA from Cornell University, right there. And Amit focuses on long-term investing strategies. He has taught hundreds and thousands of people how to navigate the stock market like a seasoned investor. I'm his disciple, actually. I'm learning stock market, and today the market is down.
Welcome, Amitji. Welcome.
But
Thank you, Vinney and Farrukh. Thank you so much for bringing me on.
Thank you, Ji.
Thank you for your time. Thank you.
Thank you. Really, it's such a pleasure. Could you kind of share with us, Amitji, how you came from India to Canada and give, your background and all, please? Yeah.
Thank you. Yes, actually, I came to Ottawa, which is the capital of Canada, with my parents when I was 13 years old. I did my high school in Ottawa and then pursued my undergraduate degree in computer engineering also in the city. And later for my master's, I went to Cornell University and did my MBA. My upbringing was a lot like that of a typical immigrant family, where we had just the bare necessities that we required, but we had a lot of love and support from the family. My siblings and I were encouraged to excel in our studies, which we did, and while also engaging in various part-time student jobs. Now, interestingly, I never ended up really getting a typical student job so I ended up working in commissioned positions as a salesman. But what happened was what happened was this role, Vinney, helped me quickly improve my English and also my sales skills. And these skills later helped me in high school, where I started leading small fundraising events and eventually ended up taking on leadership roles. And my academics obviously were solid, so that helped me get into engineering.
Wow.
So that's in a nutshell how I got there.
I have a quick question, Amitji. Where are you from in India? Which city?
I'm from a city called Jammu, from the state of Jammu and Kashmir.
Oh, Jammu and Kashmir.
Now the Union Territory of Jammu and Kashmir.
Oh my God.
Beautiful place.
Beautiful place. All those Wadiyan and Gatai.
Oh my goodness.
And Dal
Endless mountains.
Very nice. Awesome. I have a question I want to ask. I want to know, how did you make that transition from, your master's and into your entrepreneurship? Like, how did you work for somebody for a little bit, or what was your thought process when you actually became an entrepreneur, business owner? What was it, if you can share that?
I mean, there were a few events that kind of inspired me to get into entrepreneurship. So what happened was towards the end of my first year in engineering, I saw an opportunity to start a dot-com business with one of my childhood friends. And we were targeting the South Asian community. And our platform gained a lot of popularity, and which we later used to produce a dance and music event also in the South Asian, for the South Asian student associations within Canada and some in the US. Now, this is where, remember, I was saying like my sales skills that I developed as while I was in high school. Well, those sales skills really came in handy, which helped me promote the show. It ended up leading into producing sold out events. And ultimately, in my third year, I had to rent a hockey stadium because there was no venue in the city, in the capital of Canada, that could hold a show of that caliber. So it was these ventures during my undergrad that sparked my interest into entrepreneurship. So not only I was no longer just your typical engineering student, but I was seen as an individual who was carrying on businesses, and that helped me carry on in this journey.
Awesome. Awesome. Some major milestones. Can you think about some milestone that really turned, and then you got into stock market and learning, and how did that start?
I think it was really the major milestones, which were kind of like turning points in my career, were number one, when I started and ran a successful dot-com business during my undergrad days. Then second was graduating from computer engineering while there was an economic downturn in technology, which was 2002, 2003. And this was the biggest downturn in the technology that had ever happened. And that was just a time when I was graduating. So this ended up pushing me to start various businesses and also start working as an independent consultant because there were no jobs in the market. Then next was gaining a comprehensive education in business through my MBA at Cornell, which laid the groundwork for my future business endeavors. And lastly, I had to unlock the stock market success, which was through some of the inspiration I got from a case study I studied at Cornell, and then which I used, and the case study was on hedge funds. So I read that case study, and that inspired me that as I started doing well in the stock market, I thought, hey, why not go back and start that hedge fund? So which I ultimately did with people I met through my during my training journey of learning about the stock market.
So just for the people watching really quickly, if you can kind of explain people what is a hedge fund, what do you guys do? Most people probably know, but a lot of people probably don't know. If you don't mind, please.
Hedge fund is an alternative investment. These are typically open to people with certain kind of net worth, and hedge funds can be, or these alternative investments could be many-folds. They could be in real estate, venture capital, debt funds, hedge funds. Hedge fund essentially is a concept where an investment is made in some industry that hedges the market downturns. So people could be investing in any kind of opportunistic opportunities and that could even be, doesn't even have to be in the stock market. Our focus for the fund that we have is in the stock market. Our focus is investing for long-term investment, but there could be hedge funds that are based on crypto investment. There could be trading occurring. Like there's no end to it. So you can have it in any way.
Interesting.
And
it's so.
And what
No, go ahead. Follow up.
I'm so sorry. I want to learn as well. I want to know, like, what are you guys investing in primarily? Are you guys investing in stocks, real estate for your fund?
In simple terms, stock market.
Stock market.
Okay.
Publicly traded
Vinney,
equities
go
in
ahead.
the stock market.
No, that's because I've invested with Amit, and I'm very, very pleased with the results and everything. Again, we are not selling any securities or anything in this podcast. These are just our, educational purposes only.
That's right. Vinney actually happens to be an investor in our fund. So
Actually, I'm learning so much, and we are even putting together, hopefully, like a university to really teach some of the intricacies for passive investors. And we have Passive Wealth Symposium website and everything and all those things. But let's get into, I know this is, we are recording this. We just finished the first quarter of 2024, and we asked Amitji to kind of share what really happened in this quarter and what his outlook is for 2024, rest of the year. So it would be really amazing if we are able to, get that going, and you could share the screen also. Amit
Okay, Vinney ji, that's perfect. Actually, that's exactly what I'm going to do. I happen to have a small presentation, but it's a very comprehensive presentation, which is going to go through what has happened this year and perhaps last year, why it happened, and
Yep.
also what I anticipate. But more importantly, I wanted to make this presentation um, in such a way that a person watching can start to understand, when they read Wall Street Journal, what does it really mean?
Yeah.
And instead of just depending on the market gurus, you can actually start figuring out those things out yourself, probably
Yeah.
in many cases better than those market gurus. So let me show you. So I have a
Nice.
presentation which I'm going to share with you.
Sure.
Kindly let me know if you're able to see it.
Yeah, we are able to
Yep,
see.
we can. Yep.
Yes.
Perfect. Perfect. So let me just expand it, grab a pen. My pen works. Okay. So folks, here's a presentation that I've created. My name is Amit Chandan. Now, if you're interested in conducting your own market analysis or diving deeper into the insights that I'm going to share with you today, folks, I'm here to help you. Connect with me on Facebook. My Facebook channel just started last week. Previously, I used to do a lot of this kind of content on YouTube, but my Facebook channel just started last week. It's a page, and the access is Amit Chandan Financial Knowledge. And if you don't remember how to type all that or don't have the time to copy it, just take your camera, take a scan of this QR code, and it's going to take you
Yeah.
to my
I
page.
love it. Love it.
And what I'm going to share with you is, if you so want, I can share with you a document that contains all the facts and figures that I share here, along with the resources, so you can click on those and do a bet and read that stuff online, because this information is freely available online, and better enhance your understanding. That's ultimately my goal. But before we get started, let's dive into the legal disclaimer, folks.
Yeah.
This video and the marketing content that the material that I have is not any offer to sell securities or provide any investment advice.
Yes.
I am not a certified financial advisor or a financial planner, so please consult one for your own advice that you would require. Throughout this presentation, I'm going to use various sources, but as you know, accuracy cannot be guaranteed. Remember, past performance doesn't guarantee future results, and investing carries risks. So consider your objectives and seek professional advice. Folks, with that said, let's get going. So what I have in front of me is a chart that shows a whole bunch of squiggly lines, right? But these squiggly lines represent indexes. And indexes with their performance from 1 year up until today. So this presentation's got figures up that are accurate as of today, or up to date as of today. So first of all, what is an index? Many of you might be wondering. So index essentially is a method to track the performance of a group of assets in a standardized way. And the groups that indexes measure can represent any different area in the market. And the common indexes that we listen to, or what you might have heard, are S&P 500 index, which consists of 500 largest companies across different sectors. And it makes up approximately 70 to 80% of the US stock market capitalization. So when they say market is going up, what they're really referring to is the S&P 500 is going up. Okay. Next, we have the Dow Jones Index. Dow Jones Index narrows that list of top companies to just the 30 largest companies in the USA. NASDAQ Composite Index has 3,000 companies and is predominantly focused on technology. And lastly, you have Russell 2000. And Russell 2000 includes 2,000 small to mid-sized companies in the US, where the median is about 1.15 billion, which means more than half of the companies are actually small companies.
Wow.
So let's look at the performance of these companies exactly 1 year till today. So S&P 500 is represented by these candle charts. So S&P 500 up till today has brought in 27.14% in 1 year.
Wow.
Dow Jones Industrial, which is top 30 companies, has brought in 19.32%, while Russell 2000 has brought in 15.78%, right? These are phenomenal figures. But the NASDAQ, which is represented by NDX, right? These are predominantly technology companies. It has brought in 37.51% in 1 year. Right? These are phenomenal growths.
In 1 year, yeah.
In 1 year. And on average, S&P brings in about 10%, NASDAQ about 14%. And these are compounded annual growth rates, not simple interest, but compounded annual growth rates. So when people say that I don't invest in the stock market because, it doesn't return well, I think those people need to rethink all this. And the figures that I'm bringing up are not figures that I'm just making up. This is like, this chart is from TradingView, and it's freely available tool. Just type www.tradingview.com and you'll get this information. Now, carrying on, I also have a similar chart that I created from TradingView, which shows performance of different asset classes. So first, I have obviously the Nasdaq 37.72% and S&P 500 27.23%, and the decimal points is slightly different because I took the snapshots at different time during the day. So previous one has point something else, but these are essentially 37 and 27% of Nasdaq and the S&P 500 respectively for the past 1 year. Now I'm comparing that with a few other assets which are very popular, right? So Indian people, for example, want to put money in gold. Well, how has gold been doing in 1 year? It's 18.52%. Now that's pretty good, but if you look in the long run, gold is basically flat. Okay. I don't like to invest in gold because gold is a non-performing asset. And what a non-performing asset is that it's not an asset that makes anything, right? Like I have a gold ring, but it doesn't produce me more rings. It's just one ring, or gold chain. It's just one.
Yes.
Whereas Apple products, for example, they'll produce more iPhones, right? Microsoft is going to produce more software.
Yep.
So gold is a non-performing asset. Its up and down goes basically on supply and demand and people's interest in it. Then you have energy. XLE. This is represented by an ETF. So energy over the last year has given 15%, obviously less than the S&P 500. Then you have utilities, XLU, which has given 8.229%. And then you have real estate, which is also represented by an ETF, and that has returned 5.19%. And that has nothing to do with like the kind of work Vinney ji does.
Yes. Let's qualify that.
Important to note that.
I know, very important.
Should I put
my jaws just dropped. I didn't know that it's 5.19 in 1 year. So this is like REITs and others. Is that right, Chandan?
This is ETF, not REITs.
Oh, ETF.
Exchange traded funds. So they may invest in REITs, they may invest in other asset classes, but they're trying to show that this is general market.
Got it.
So a person doesn't actually have to buy a property. Like if they just so want, they can buy and sell REITs. They can buy and sell the ETFs of real estate, energy, utility, gold, and whatnot. Okay. Moving on. Today's March 23rd, right? Do you guys know that S&P 500 has today marked the all-time high? So S&P 500 has reached its all-time high today.
Wow. Okay.
Over the course of a year, you guys might have remembered that last month there was a lot of panic in the market, right? S&P 500 went down. And how much did it go down? It went down by around 5.9%. It went down.
Wow.
But since the middle of April, which is since the middle of last month, it has already not only recovered that whole loss, but it's also gone up and has now achieved 7.8% since the middle of April. And this year, it's already gone up over 12%.
Sure.
S&P 500. That's S&P 500. I'm not talking about NASDAQ. Those have even better performances. So I wanted to bring this up to show you that, yes, it went down. And during the presentation, I'm going to explore reasons why it went down. And after the presentation is done, you're going to realize that when things like these happen, what do you need to look at? And then that they're not necessarily things to panic, right? There are patterns that happen in the market.
Yeah.
Okay.
I'm already learning so much, Amit ji. I didn't like.
I'm sure
things
everybody
the right
watching
way.
or listening to us, I hope this episode, please share this with other people and give comments and give us 5-star reviews, because that's how we're going to bring greater
value,
and value to us. Thank you, Amit ji. It's so wonderful. Yeah.
So now,
बहुत शुक्रिया.
धन्यवाद. Acha. So now, carrying on with the same thought, the same mind frame, it's important to look at what happened in 2021, and that continued until the middle of 2022. And what was that? That was inflation. Remember,
Yeah.
inflation was something everybody was talking about. I had a
Yeah.
conversation with Vinney last year, right? And we were discussing the inflation and how that directly impacts the real estate market. Well, it actually impacts everything, right? I'm going to talk about that right now. So what I have here is a chart that represents inflation. So it's a chart that represents inflation, and it shows what was happening to it. And if you notice that uh, late 2020, early 2021, the inflation started to rise.
Mhm.
When it started to rise, the feds had to come in, right?
Mm,
Because when the
yes.
inflation goes up, it leads to an increase in the prices of goods and services.
Yes. Yes.
Clearly, right? So to curb inflation, the Federal Reserve had to come in. And what they wanted to do was to make the free money
Mhm.
less accessible to people. So why was inflation going up? Because there was too much money freely available. What that basically means is interest rates were so low, practically zero, that any Jomo on the street was taking loans, refinancing their properties, or whatever way they could get a hand on loan, and either investing in all kinds of assets. And I'm not saying whether they were good assets or not, but they were just taking the money, investing in assets or investing in their businesses, or just taking that money and going on vacations and spending it in the economy. And what was that doing? It was making, when the demand continues, when you spend money, the demand grows. When the demand grows, the prices of things grows. And when the prices of things grows, things become expensive, right? They become difficult for people to achieve. Consequently, the inflation was increasing, which basically is another word for things were becoming expensive. So when things were becoming expensive, the feds had to come in and they had to curb the interest, curb the accessibility of that money in order to lower inflation. And how did they do that? Well, one of the toolkits they have, or one of the tools they have in their toolkit, is a control over interest rates.
Interest rates.
So what
Yeah.
they started doing was they said, okay, well, we're going to increase interest rates.
Mhm.
Well,
Wow.
while the interest rates had increased in the past, what happened this time was that they grew at the fastest rate in the history.
Yeah.
Okay. So
Yep.
as they grew at the fastest rate in history, or in essence, as they grew, what happened was the debt started to become more expensive. As the
Yeah.
debt started to become more expensive, Fed started to achieve what they had hoped. So somewhere in July, where the inflation had peaked to 9.1%, it
Wow.
was just a third or fourth hike of interest rate. Notice the inflation rate started to go down.
Yeah.
Yeah.
This is
Wow.
exactly what they wanted to do. So interest rates started to go down. And as the interest rates started to go down, it also spooked. Sorry, not interest rate. I'm sorry. As the inflation rate started to go down, the interest rate continued to increase. As the interest rate continued to increase, that also started to spook the stock market. And as the interest rate start to increase in the beginning, the stock market start to go down. You notice here?
Mhm.
Yeah.
But
Wow.
around this time, something else happened. Around this time, the quarterly earning reports of the company started to come out. And
Ah.
also by this time, the ambiguity in the minds of investors went away, where they realized that inflation has now started to become curbed, which means inflation is starting to go down. And they knew that interest rates will increase, but they will stop increasing because the
At some point.
FOMC
Yeah.
had started to give their indications. And I'm also going to talk about FOMC in the next little while.
Mhm.
So when the retail investors start to get an idea that they know what's going to happen, so there's no longer that ambiguity, look what happened to the market. The stock market stopped going down and started to recover after that. Right?
Nice.
It
Okay.
continued
It
to
makes all
recover
sense.
even though interest rates were increasing. Why? Because the ambiguity had gone away from the market.
Ah.
They
Yeah.
knew what was happening. And the earnings that were coming out of the company's quarterly earning reports were
But
also
stronger.
good.
They were good. Yeah, Anji.
And the goal of the feds was to lower the inflation to 2%.
Yeah.
Now, while I understand, even till today, the inflation has not gone down to 2%. In October 2022, uh, since October 2022, the market went up by 51%.
Ah. 50.
Wow.
Okay. Now the question is, did the stock market go up solely because of reduction in inflation? Maybe, right? We know that the stock market performs better when the intrinsic value of the stock prices increases. which only happens when the profitability increases. Intrinsic value, Vinney and Farrukh, is another word for fair market value of a stock. In the long run, the stocks always reach the intrinsic value, the fair market value. In the short term, the stock market is emotional. So so we know that the higher interest rates lower the profitability, right? So as interest rates increase, which here interest rate is increasing, it is supposed to reduce the profitability of the company because the debt is expensive.
Yeah, debt is there. Absolutely.
So when the debt is expensive, why did the stock market why did the stocks of some companies still continue going up? Or why did the stock market continue going up even though the inflation rate, even though the interest rates were increasing? The answer is that all the stocks in the stock market did not go up, even though a 51% return was observed. What happened was only a few stocks went up last year. Okay? And this is very common. Whenever the market goes up from a downtrend, all the stocks don't actually do well. Only a few stocks do well and they lead the way. And then investors take money out of that and put it into other stock, which is called a sector rotation. And I'm going to show you exactly how that's happened by the book.
Wow.
So the stocks that actually went up last year were called the Magnificent Seven.
The big ones.
Right? And what are these? These are the so-called highest quality companies to investors because they create high cash flow from
NVIDIA, today we are recording and
that's
NVIDIA
over
went
$1,000
to the roof.
Yeah.
I mean, I knew that from yesterday and I've been following and buying. Oh my God, this is my stock.
And so these companies have high cash flow from operation. They have high consumer stickiness to their business. Consequently, higher intrinsic value, which is the higher fair market value. So last year, these companies did very well. But as the inflation started to go down, remember inflation I was showing you in previous slide, inflation was up in July 2022, then it started to go down. When inflation started to go down and the stock market started to do well, what people started doing was they started taking profits out of these companies and started putting them elsewhere. That is called sector rotation, and that's actually a very healthy sign and a sign of strength in the market.
Okay? Nice.
So before I delve deeper into it, I want to talk to you guys about sectors. So what are sectors? Okay. And you'll often hear things like, oh, the technology sector is up, the utility sector is up. What does that actually mean? See, sector is a broad category that groups together companies that operate in similar industries or provide similar products and services. And each sector typically consists of multiple companies that basically share common characteristics or business activities, and they follow common economic trends. So if technology is going to go up, you know what? Almost all technology companies are going to go up. And there are also many reasons for that because there are ETFs for it as well. So when people start putting money in that ETF, the ETF spreads money equally or to some sense in different companies in that sector. So when ETF goes up, the sector goes up, or when the index go up, the sector goes up. And they're also backward related. So these relationships exist. So first sector is called the technology sector. So technology sector are companies that are involved in development, manufacturing, distribution of technological goods and services, including software, hardware, electronics, information technology services. And the common companies are your Apple, the Microsoft, Google, Amazon, Facebook, right? And Intel Corporation. Then you got communication services. So these are telecommunication companies, media, entertainment, internet services. And common companies are AT&T, Verizon, Netflix. Then you got financials. What are financials? These are banking, investment management, insurance, real estate. For example, JP Morgan, Bank of America, Wells Fargo, Visa, MasterCard, etc. Then you got consumer cyclical, right? These are companies that produce non-essential goods and services. So not essential, but non-essential. So these are things like Nike, Starbucks. These companies typically do well when the economy is doing well because people have money to go buy expensive shoes or whatever, right?
Disposable income.
Yep.
That's right. Then you have industrial. Industrials are industrial goods, machinery, equipment, engineering products. So there's companies like General Electric, Boeing, Caterpillar, 3M. Then you have energy. These are companies that want to do exploration, product or production or refining or distribution of oil and gas, natural gas. Companies like ExxonMobil, Chevron Corporation, Shell are common names. Then you have basic material. So these are raw material, chemical, mining, forestry. Examples are BHP, DuPont, International Paper Company. Then you have healthcare, right? Pharmaceuticals, biotechnology, healthcare facilities, medical devices. For example, Johnson and Johnson, Pfizer, United Health. Then you got real estate. So real estate are companies that own, develop, manage, invest in real estate, like Vinney's companies. So others, big companies in this industry are Simon Property Group or American Tower Corporation, Public Storage. And then you have consumer defensive. So these are goods and services that are considered essential. They're purchased regardless of the economic conditions. So these are very common companies called Procter and Gamble, Walmart, Coca-Cola, Pepsi, Colgate-Palmolive, Costco Wholesale. And lastly, you got utility companies, right? These are electricity, water, natural gas distribution. So companies like NextEra Energy, Duke Energy, American Electric, these are examples of those. The examples that I provided, these are just a few of the companies within each sector, but there are obviously many, many more. But why did I go through this?
Yeah.
The reason I went through this is so I could show you how, what are sectors and how sectors have been behaving over the last little while and how sector rotation is now starting to happen.
Yeah. And
So let me
also
show
the
you sector
percentage, like if we say certain Dow and S&P, would it say that what percentage would be each sector? Amitji?
You can
Ah.
S&P 500, like if you read the composition of it, you'll be able to see how many of those fall in different
Like
sectors.
40% is in this one, 20%.
Yes. If you read the compositions, their diversifications, you'll see that. You'll also be able to see within the technology sector or NASDAQ, how many are communication services, how many are pure technology, how many are artificial intelligence. Like they have other kinds of diversifications within them.
Totally.
So with the chart that I have in front of me, what I did was I went to FinViz and I took some numbers and put them in Excel and I outproduced this chart for you. What it shows you is performance of different sectors as of today, by the way. But what's in blue shows the performance of sectors as of all of 2023, so last year. Then in orange, it shows how the market behaved in these sectors from January this year till the end of April. And this blue, light blue, shows 1 month performance up until today. So let's see what's going on. And I want you guys to notice something very interesting. So, last year, technology, communication services, financials, consumer cyclicals with the big blue lines, right? They showed how that they performed really well. What did not perform very well was utilities last year. Now, this year, up until April, notice money was removed from technology and technology actually went down. Not all the money obviously was removed, but look, technology, instead of going up like north of 50%, went down until April. Financials, which increased somewhere around 15% last year, went down. Right? Then industrials went down. Energy went down. It didn't go up a lot last year, but it went down a lot this year. Basic materials went down. Healthcare went down. Real estate went down. And then consumer cyclicals went up. So somewhere from the money, so that was removed from these companies, these sectors, either stayed in cash or it was directly taken away and put into some other companies, some other sectors, which then started to go up. Right? This money, after all, came from somewhere. And what happened in the last month, exactly from May 23rd, 1 month past, notice the money that had gone away from technology went back into the technology and technology started rising. Right? Communication services rose again. And basic material, for example, which had gone down up until April, has now again this month gone up. Healthcare has gone up. Real estate has gone up. Consumer defensive has gone up. And utilities has continued to go up this year. So this is what shows sector rotation. If I were to create a quadrant where I were to say, a sector or a growth, it would basically say how dollar moved from here to here, and then here to here, and then here to here, and then back from here to here. This rotation continues to occur. It's very normal. Last year, the Magnificent Seven that had done well, if you notice this year, those stocks may not necessarily be doing all that well, or all of them may not be doing all that well, but other sectors, other stocks have now started to follow. And this is very common trend that happens when the market goes from downtrend to uptrend. Now, I also want to bring to your attention the macroeconomic factors that provide a broad context into the financial markets in which we operate. So by understanding these factors, you will be better able to understand market trends, investment opportunities, and you're also going to be able to enhance your ability to navigate the complexities of the financial market. So in order to do that, there are two very important things I'm going to explain to you. First is called CPI, Consumer Price Index, and annualized inflation rates. So I want to tell you what these are.
Yeah.
CPI measures, or the Consumer Price Index, measures the change in price level of a basket of goods and services over time. And in our case, monthly. Okay. This is another fancy word for inflation, but monthly inflation. When the annualized inflation rate basically projects the CPI, which is a short-term figures, over the full year. So it projects it over the full year, and it provides a long-term view, and that's why it's called the annualized inflation rate. Okay. So let's look at what happened. So you notice, and by the way, other thing is that the inflation rate is always, the CPI rates are always shown for the previous month. So on May 15th, which was just, I think, last week, right? May 15th, the latest CPI figures came in for April. So this came in, this for April, it came on May 15th.
Yes.
And the CPI, which is the inflation, went down. Okay. But in the previous, up until the previous months, the inflation was increasing.
Yeah.
And the last 2 months was constant.
Yeah.
In April, what came out was 0.4 CPI, which was consistent with the previous month. Notice what that's going to do in the mind of investors. People are going to say, oh my goodness, inflation is going up. And if inflation goes up, the feds are going to come in and they're going to increase interest rates.
Yeah.
That's going to spook investors. And when that spooks investors, they take money out of the stock market and they put it in bonds.
Yeah.
Right? Correct. I'm going to show you those relations as well, so you can make those, you can understand those trends. But based on these trends that are coming up, the feds have a job to decide what to do with the interest rates. Remember, interest rates in the US are currently between 5.25 and 5.5%. And this is what has made the cost of the mortgages very expensive, which impacts everybody. And the feds have a job of balancing interest rates based on economy. So they don't raise the interest rates too much, which is going to halt the businesses or business activity, while at the same time not let the inflation go out of control by lowering the interest rates too much. So the Federal Reserve holds a meeting called the FOMC, which stands for Federal Open Market Committee meetings. And they do those 8 times a year. And FOMC determines the target range of the federal funds rates, which is the interest rate at which the banks are going to lend money to each other. It is this rate, folks, that influences the overall economic activity, influencing employment, inflation, economic growth, and everything. The current chair of the FOMC is Jerome Powell. And I'm sure you must have heard this guy's name.
Powell, yeah.
Very important person, Jerome Powell.
Yeah.
So based on the most recent meeting, which was just held 2 weeks ago, what is the likelihood of the feds increasing or changing the federal target interest rates in the upcoming FOMC meetings? Well, there happens to be a tool called Fed Watch tool. It's freely available online. You don't have to subscribe or pay for anything. And there, they place probabilities of the interest rate changes. And I have taken 4 of those and placed them right here so you guys can also see. So first one shows me what is the probability of the interest rate in July, on the July 31st meeting. So if you notice here, you'll notice it says, so if you notice here, for the July, it said the interest rate of 5.25 to 5.5, which is calculated in basis points. So that's why you don't see the decimals. So 525 to 500 points. The probability of it remaining there is 86.8%. And that's basically the current interest rate. That means in July also, the probability of the interest rate remaining there is very high, 86%. Okay. Next federal meeting is supposed to, or FOMC meeting is supposed to happen in September.
Yeah.
In September, probabilities are beginning to change. The
Oh,
probability of the interest rate remaining where it currently is 49%, while the probability of it going down is now sitting at 45.1%, which means there's a very high probability, almost equal probabilities, that the interest rate may change and go down to 500 to 5.25%, or
wow.
5% to 5.25%.
Okay.
So it's going to go down by 25 basis points. Now, let's go forward to the next FOMC meeting, which is right here, and that is the November meeting.
Yeah.
In November meeting, as of today, the probability of the interest rate going down to 5% to 5.25% is
It's
now
higher.
higher, 46.8,
Oh,
whereas the interest rate remaining at 5.25 to 5.5, which is the current interest rate, has gone down to 34%.
oh,
So that means there is a probability that based on how things are happening right now, interest rates are going to start going down.
right.
Okay.
Little bit
Now,
though.
going down to December,
0.25.
yeah,
Maybe
going down to December,
Hmm.
the interest rates remaining at 5 to 5.25% are the highest, which means they've already gone down. But the chances of them going down to 4.75% to 5% are now starting to rise up. So if you
Oh,
go
wow.
up to the following year, chances are the interest rates will continue to go down. Now, if I bring my pen and I'm going to show you what this basically means is if the interest rates are here,
Mhm.
right, somewhere around November or even like September. So
Mhm.
September to November, chances of interest rates starting to go down are very high. Now, to what level they go down? No, obviously nobody knows that. But the
Mhm.
probabilities are now starting to appear. Because if you were to look back a year and a half ago, you weren't seeing
Yeah.
the interest rate going down. You were seeing probabilities of interest rate going up,
Yeah.
right?
Yeah.
That's why
Higher.
when
Yeah.
people were looking at these retail investors were looking at the Fed Watch tool and they noticed that, yes, interest rate is expected to go up to a certain level. They're like, okay, we're comfortable with that. We're going to invest back in the market. That's why the market started to go up after July 2022.
Okay. Makes sense.
But now the probability is that the interest rates are going to start going down. But again, I want to impress upon you guys that these are just expectations,
Mhm.
probabilities. There is no guarantee, right? Who
Ah,
knows? There
Yeah.
could be another war tomorrow, or there could be another pandemic. Like nobody has an idea. The inflation could go up for whatever reason. So, like last year, analysts remember were expecting a recession. It didn't happen. They were
mhm.
also expecting a rate cut earlier this year. That also didn't happen. But
Happen.
it's good to know that these figures, because using these figures, you and our viewers can start to have better understanding. And when you guys, for those of you who asked me for the document of sources, I'll send you that. Click on those sources and read up on this stuff because it's going to enhance your knowledge of what's going on in the world.
Beautiful. Beautiful.
Now, how many of you have heard people talking about bonds and how some people invest in them?
Yeah.
Right? I'm sure a lot.
Yeah.
Even the WhatsApp group we're a member of, there are people who
Yes.
invest in bonds.
Yes.
Now, bonds are important because they give us clues about what's happening in the economy. They also give us an opportunity, or give several of us an opportunity, to invest in instruments that are very secure. Okay. But before I dive
Yeah.
into that, I want to first give you an understanding of what bonds actually are.
Hmm.
Okay, folks, US government, and many governments for that matter, like government of India, government of other countries, they all have bonds. So US government also issues different types of debt securities, such
Mhm.
as treasury bills. And treasury bills are basically bonds that mature in up to 1 year. Then they have treasury notes, which mature in up to 10 years. And the other thing they have is called treasury bonds, which mature in more than 10 years.
Hmm.
Okay?
Wow. Yeah.
And when you buy these bonds, so for example, let's say you buy a 10-year treasury note, what you're basically doing is you're lending money to the US government.
Yeah.
Okay, US government is raising money. So when you buy a bond, you lend money to the US government. And these notes are exempt from state and local taxes, but they are subject to federal taxes. But despite their tax benefit, in the long run, treasury notes might not offer high returns compared to the stock market. And I mean, if you just Google or go to TradingView and do 10-year treasury yield with the S&P 500, you'll see that treasury yields don't produce such better results in the long run. But many institutional investors prefer to buy them because they are relatively safe and very low risk because they're backed by the US government, right?
Mm-hmm.
And when they're backed by the US government uses them to raise money. And when they want to raise money, they do what they call bond issuance.
Mm-hmm.
The return you get from the bond is called a yield, Y-I-E-L-D. So it's called a yield.
Great.
The supply and demand of bonds determines the yield, okay? Which means when the supply of the bond goes up, which means there are lots of bonds in the market, the demand goes down. And when the demand goes down, the yield goes down. That's why
Yes.
the bond prices are inversely proportional to the bond yields.
Yes. That makes sense. Okay.
Okay?
Mm-hmm.
So, and in essence, they move in the opposite direction. The 10-year treasury note is especially important because its yield indicates the long-term interest rates. And it also affects how we calculate the present value of the future cash flows of stocks, which means we use that to determine the fair market value of stocks.
Makes sense.
Higher bond yields increase discount rate, and discount rate is used as a denominator. So if I call discount rate is used in the denominator to calculate the net present value, which is the fair market value of stocks. So when the discount rate goes up, the stock values come down. Therefore, when the bond yields go up, the stock market goes down.
Goes down. Yeah.
Because the fair market
Yes.
value goes down. There's a mathematical relationship between these two. Okay?
Love it.
And I'm going to use this. This is why I wanted to explain this to you, because I'm going to use that concept to show you when the stock market goes up, what happened to bonds. And that's how you can start to figure out what's going to happen to the stock market
Mm-hmm.
in the short term, not in the long term, in the short term. So here I have chart with two items in it. So the candlestick shows you the 10-year US Treasury bond yields. Okay, so this is the 10. The candlestick represents the S&P 500, and the blue line represents the 10-year US Treasury bond.
Ah, yes, yes.
And or its yield. You notice something? You notice they're almost
Inversely.
going in opposite direction.
Yeah, opposite.
Yeah.
Uh-huh.
So last year, when the stock market had fallen, which is right here, notice what happened to the 10-year Treasury yield. 10-year Treasury yield went up. Right?
Mm-hmm.
And what was happening at that time? Remember? Inflation.
Mm.
High inflation caused interest rates to go up.
Yep.
And when that happened, the investors
People took money out of the stocks and put in the bonds.
Exactly.
Sure.
Took money out, put in the bonds. And
Wow.
then when the results start coming out and people start developing interest in the stock market or confidence in the stock market, and stock market started to go up, look, people took money out of the bonds and threw up in the stock market,
Yeah.
and the
Yeah.
stock market performing better.
Yeah.
Right?
It's a constant thing, huh?
Yeah.
That's right.
If
And
it-
Wow.
notice that this April, what happened? Stock market went down. Why did stock market went down? Because the CPI figures wouldn't go down. They were stuck at 0.4%. So people start getting spooked. When people start getting spooked, they start buying the bonds. When they start buying bonds, notice stock market goes down because they take money out of here and put it in bonds.
Mhm.
And then later on, when they realize, well, the CPI figures are going down, which means inflation is going down, they would take their money out, put it back in the stock market, and the stock market went up. In the long run, the stock market beats the bond market. So
Yeah.
that's why, but investors in the short term get spooked easily. They're like, oh, maybe it's going to go down for too long. They immediately take cash out and throw it in bonds.
Mhm.
That's why
Yeah.
you will often notice an inverse correlation here.
And as we get younger, I say not older, people do have a mixture of stocks and hedge funds and everything and bonds.
That's
So
right.
that
People have a mixture of those. That's
Yeah.
right. And I would urge them
Yeah.
to objectively look at their portfolios and see how their collective portfolio has done compared to the very simple index, which is the S&P 500.
Yeah.
If they have majority of their money in bonds and all kinds of things, but they're not able to beat the S&P 500, I think they ought to reanalyze their portfolios.
Mm.
All right, moving on. At this time, all that I've told you, you guys must be thinking, okay, Amit, well, what's next? Right? What do we expect
Rest
the
of the
markets
year.
to do?
Rest
How
of
do
the
we
year.
expect it to
And by the
perform?
way, I want to put a plug. Everybody watching us and also listening to Amitji's presentation, we're going to invite him back every quarter, and he's agreed to that. We're really thankful so that we could go over like Q2. So please do, keep on following Desi Money Show so that you are able to be abreast of, stock market and other different things we'll be bringing to you in every episode. So look forward to seeing Amitji again after Q2 ends and Q3 and Q4 like that. Thanks.
Absolutely.
Wonderful.
So again, so what's going to happen in the near future? What do we anticipate? Well, as you all know, no one has a crystal ball.
No.
But we can look at historical trends. And I am a firm believer, from my experience, what I've seen is that the stock market is highly responsive to US presidential election cycles. Okay? After all, US president is probably the most powerful position in the world, right? So, and this is the US stock market. So clearly it is very influential. This is currently the fourth year of the US presidential election cycle. And I have a chart here. So this chart here, it shows me average historical presidential cycle returns from 1928 all the way to 2012. Let's see if the market behaved in a very similar way. Okay. So November, right, when the US election cycles, elections happen, what happens at that time? Market generally, after the elections are done, the market goes up. And up here, I have the S&P 500 from the same point up until today. So let's see what happened. So US market goes up. Or sorry, historically, the market is supposed to go up. Well, did that happen? Yes, it happened. Then the market is supposed to take a dip. Did that happen? Yes, market took a dip. Notice in the same year. I'm not even like trying to do some strange correlations. Then market goes up and then falls down the next year. Did that happen? Market went up and then fell down next year. Then the same year towards the end September, October timeframe, the market is supposed to pick up. But look, in September, after September, October, market again picked up. And then the market is supposed to, in the third year, carry on generally all the way to the top. Did that happen? Yes, market generally went up. There is supposed to be a dip around this time. And look, there was a dip around that time.
Yeah.
Isn't that interesting?
Now, very interesting. Yeah.
Wow.
Now, carrying on.
Amazing.
So this here is the end of that year. And I have in red today. So from that year onwards, the market early on is supposed to be slightly stagnant, slightly supposed to go down. This year, that did not happen at the start of the year. But what did not happen at the start of the year happened in April. There was a dip. After that, there is typically supposed to be a dip around May, June timeframe, June-ish. So market is right now at an all-time high. It's possible that the market could take a small dip, and then it's expected the market goes up till about September, take another dip, and then finish the year off high. So it's possible that the market may go down and then go up, or it may carry on up, but there is typically supposed to be a dip because market never goes up in a straight line. But the ultimate crux of the conversation is that even in the fourth year cycle, the market historically is expected to end at a bullish and a positive note. So far, S&P 500 has already grown by 12.22%. We already know that.
Yes.
Right? So I personally think the market should be able to cross 20% this year. But again, those are probabilities. Nobody really knows.
So are you thinking then the NASDAQ will go higher, just like traditionally the NASDAQ index goes
My
higher?
expectation this year is that the stock market should end at a higher note than where it is today. But again, remember, I want to tell you guys that these are all probabilities. Even a 90% probability means that there is a 10% probability of a downturn.
Sure.
But that's why my focus as an investor
Mhm.
is to buy long term. And I think I want to clarify something. Majority of the people invest in the stock market actually don't even know the difference between investing and trading.
Hmm.
And people are like, oh,
Yeah.
we lose money in the market. Well, you don't know what investing and trading is. Investing means procuring stocks of good quality companies and holding them for the long run.
Sure. Sure.
Whereas what a lot of people do is they buy a stock and then they sell it in a month or so and they say they're investing. They're not investing, they're trading. Trading
Yeah.
is called buy and sell, short term.
Yes.
Investing is long term. Okay.
Sure.
So my philosophy is there is a mechanism, there is mathematics behind figuring out great quality companies. Great quality companies lead the way. For example, the Magnificent Seven. Now,
Seven.
I'll also tell you, I don't think all stocks in the Magnificent Seven are great. I think one company definitely is not great. I don't invest in that. But there's a mathematical way of figuring this out. So
Mhm.
learn that way, invest in great quality companies because in the long run, great quality companies do really, really well.
I remember that company very excitedly, and I not bought in that. I was going to ask you, Amitji, this is so wonderful what you're sharing with us. I think lots and lots of accredited investors, entrepreneurs, they want to know more about how they can grow their monies and everything. Maybe there is a way that we could have you in smaller doses so that our followers can really understand the market. Maybe Farrukh and I will talk, and rather than doing
Yeah.
every 4 months, maybe we might even interject in between to give some
Yeah.
financial language. Huh? Farrukh?
No problem at all. I'm
Absolutely.
actually
Yeah, I
full of
agree.
pleasure
Totally
to be
agree.
meeting.
I
This
think
is
it's
great information. My God.
so important, so important. And I think by analyzing the companies which you did with me, Amitji, I still remember that. I was playing and I was
We
losing
shouldn't
money in
name
that
names of those
company.
companies because that's
And
not
it's
fair.
$1 trillion, company. And we did that whole thing. And we said, no, 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 we should not invest in it anyway.
That's right.
So,
That's right.
no, thank you.
And there are
Please.
some very popular names. People, I get surprised. People offer
Yeah.
money left, right, and center, and I'm like, and I want to tell people, I'm like, you don't do that, but I can't influence people's investment
No.
decisions. Um, so yeah, people go ahead and unfortunately, what happens is most people invest based on a tip they received from their buddy in a
Yeah.
bar the night before,
Yes. Yes.
but that's not how you should be investing.
Yeah.
Anyways, what you've heard me speak so far, um, and you must have heard me like, I've repeated that a few times that the price of stocks ultimately reach their fair market value, right?
Hmm. Hmm.
And that fair market value is governed by the earnings of that share. And
Yeah.
as you know, we've wrapped up so far the Q1 earnings season,
Yeah.
and the results are in.
Hmm.
Folks, S&P 500 companies have really outperformed expectations this time. More companies have beat their earning estimates than usual, and the size of these surprises is even bigger than what we've seen over the past 10 years. In
Oh,
fact,
wow.
S&P 500 is showing its highest earning growth since Q2 of 2022.
Oh, wow. Wow.
Okay. And out of all these 500 S&P 500 companies, 80% have reported their Q1 2024 results, and a whopping 77% of them have exceeded their earnings estimate. And
Oh,
this aligns well with 5-year average. So healthcare, consumer discretionary sectors in particular have delivered significant positive earning surprises,
Mm.
contributing greatly to their growth this year. So here's a chart that you have in front of, and these are charts that like freely available. Like all the stuff is available on the
Sure.
internet. Like I
Sure.
don't
We
make it
have
up, right?
about 10 minutes before Anshuji comes in. I was
Perfect.
going to
I'll be
just,
done. This is the last slide.
sure.
So this is a chart. You notice all the ones that are in green. The green area shows the percentage of companies that have actually produced positive results.
Oh,
So
wow.
these are healthcare, info technology, consumer discretionary stocks, communication services, et cetera, et cetera. So
Mhm.
most companies have actually produced high results. And when companies produce good results, then their fair market value
Goes
increases.
up.
When the fair market value increases, ultimately the companies get to that point. So
Yeah.
looking at the revenues, the 8 sectors have seen a year-over-year increases with, like I said, communication services and information technology leading the charge. But not all sectors have done well, which is what we expect. So there have been declines. in certain sectors. So these sectors are material and utilities, being the biggest, being those sectors that have taken the biggest hits. And also, these are sectors I don't personally like to invest in because they are also sectors that are that result whose performance is heavily whose performance is heavily dependent on capital expenditures. So if they stop doing capital expenditures, their results are highly impacted. So I don't like to invest in companies. I personally like to invest in companies that basically have monopolies. So folks, the information that I've shared with you is available online, and I urge you to read up more so that you too can enhance your knowledge instead of depending on market gurus. So if you are interested in conducting your own market analysis or diving deeper into the insights that I've shared with you, then I'm here to help you. Please connect with me. There's a QR code. You can scan it. You'll get linked to my public Facebook channel. Message me, and I'll be happy to send you a document that contains all these charts and their sources. You can click on them and read more and enhance your learning. This information I'm available to share with you guys free of charge. So happy investing.
That is amazing. That's amazing, Amitji. I mean, it's so exciting to have you on our show. And again, everybody watching and listening, I hope you got a lot out of this one. Thank you for your time. Remember, Amitji is going to give us every quarter the whole rundown, the whole analysis and how it's going to probably rest of the year. But then in between, we might also bring some really good knowledge segments. So please follow, like us, and give us 5-star reviews and share and subscribe to our YouTube channel, Instagram, all of that. Desi Money Show. This is Desi Money Show with Farrukh, Shakil, and Vinney Chopra. We really appreciate your, spending time. Amitji, thank you. You have spread the Chandan.
Thank you, Amitji.
All over. Yeah, it was.
I just want to say one thing, a parting comment that I learned personally more in the last 10 years. I've been learning here and there. This 1 hour it connected all these dots in my mind, how things are related. So it's unbelievable. Thank you so much for opening my eyes, at least. So I appreciate it.
Totally. And we might even, it's a large episode. We might do part 1, part 2, part 3, but also the whole presentation will be also put out so that people can listen to also in the car and everything. And then in the office, they could see the whole video on the YouTube channel also. So
wonderful.
Thanks again.
Thank you.
Really appreciate you.
Thank you, guys.
And we'll see you next time. Again, thank you. Thank you so much.
Stay tuned for our next episode. Like, share, and subscribe now, and join us as we unravel more tales of Desi Hustle.